The cup and handle pattern is used in trading as both a continuation and a reversal pattern. In an uptrend, it acts as a trend continuation pattern, while in a downtrend, it functions as a trend reversal pattern. Let's understand how the cup and handle pattern is formed. It consists of three main parts: the cup, the handle, and the neckline. These three parts combine to form the cup and handle pattern. The price trades in a range, undergoes a bearish correction, enters a consolidation zone, and then reverses bullishly to reach the neckline. This price movement creates a rounded bottom shape on the chart. At the bottom of the pattern, the price becomes less volatile, forming a consolidation zone. After the breakout from this zone, buyers re-enter the market, pushing the price toward the neckline. The price touches the resistance line and moves slightly downward in a tight range. Sellers attempt to push the price lower, but fail due to limited strength. After a point, buyers show renewed interest, start buying, and drive the price back toward the neckline. If sellers dominate at the neckline, the buying momentum may not continue, and the market may reject from the neckline, move downward, and cause the cup and handle pattern to fail. If the rejection from the neckline exceeds 50% of the cup's height, the chance of resuming the buying momentum decreases. The handle should always be smaller than the cup, forming a tight consolidation with reduced trading volume. This often leads to bullish continuation patterns like flag and pole or triangle formations, signaling trend continuation. You can take a long trade position at the neckline breakout. Let's now discuss how to enter a trade in the cup and handle pattern. You can take an aggressive entry as soon as the price breaks above the neckline resistance. Now let's learn how to set a stop loss. Place your stop loss at a level where, if the price reaches it, your setup fails. In the cup and handle pattern, if the price falls more than 50% of the cup's height, the setup fails. Thus, your stop loss should be around 50% of the cup's height to reduce the chance of it being hit. For setting a profit target, measure the distance between the cup's bottom and the neckline, then project that same distance upward from your entry point. To capitalize on a larger market trend, use a trailing stop loss method to maximize your profits. If you found this video helpful, make sure to like the video and subscribe to the channel. See you in the next video. Until then, bye.